When it comes to investing, diversification is probably one of the most important key principles that we need to learn. But so many people forget about it, assume they know it all, and then only realize when it's too late that they weren't diversified enough. So this is why in today's video, I'm going to run over everything we need to know about diversification, why it's so important, but most importantly, answer the question, are your investments diversified enough for you? So the concept is simple enough, that old saying not to put your eggs all in the same basket, because then if your basket breaks, you're left with scrambled eggs. Or in investing terms, a horrible looking portfolio that can only be described by the following video clip.
I've got nothing left.
The best way to explain things is to ask you the question, as an investor, would you rather have $1 million in a single rental house or 10 houses that are $100,000 each? Now just assume the rent you get is exactly the same and they're all in the same area. From an investing risk perspective, you'd have to be a little crazy to not want the 10 properties because so many things can go wrong with having just a single property. Anything from having bad tenants who don't pay the rent, a leaky roof, issues with the neighbours, or even something like Japanese knotweed coming up through your driveway.
How did you both feel when you realised you'd got a plant growing inside your house?
By having these 10 different properties, you can increase your diversification and therefore reduce the risk that you're exposed to. This is because even if you have 1, 2, or even 3 properties out of action for whatever reason, you still have the rest of them bringing in income compared to having everything in that single property. One important thing to note here is that even having 10 properties still carries loads of risk, especially if they are all in the same area, around the same price point, and even because they're all in the same type of asset class, i.e. property. Diversification, when done properly, isn't just about finding the right number of houses or the right number of stocks to own. There's a few more key important things we need to know about. In the investing world, the concept is pretty much the same. We're often told that we need to have lots of different stocks in our portfolio. But the problem is lots of people will tell you different numbers. You'll hear everything from owning maybe half a dozen or so to anything up to 30 stocks as some kind of optimum number. But then you'll also see that some of the world's greatest investors haven't really stuck to any kind of rules themselves. Now, as you can imagine, there's been quite a bit of research on this topic done by the academics to try and find this magic number. And if you look into this topic, you'll see and come across this research that lots of people reference when they tell you how they got to their own number. Back in the 1970s, there was research published by Lawrence Fisher and James Lorry, and they set out to answer this age-old question, how many stocks do you need to own to be well diversified? They put together random baskets of stocks from the New York Stock Exchange and came to the conclusion that there is an optimum number of stocks that you need in order to be diversified enough, and that there is a point where adding more stocks starts to reduce the effects dramatically. They produced this chart, which shows around 32 stocks is all that was needed to get 95% of the distributions from the stock market. The problem with this data, as future research covered, was that this was based on just a random selection of stocks, which, let's be honest, no self-respecting stock picker was ever going to admit to. As really, what you want is a mixture of stocks from lots of different industries, regions, and sizes, and that's just to name a few different aspects. Just as a quick example, and maybe one worth looking into a bit later, is looking at how the stock market did last year, more importantly the S&P 500. Overall, the market was down over 20% last year, as many of us would have already tried to forget about. However, if you dive into the numbers and the different sectors of the market, you may already know that the energy sector, which includes those oil and gas companies, was the only sector to finish the year positively. Not only that, but it closed up 58%, having its best year ever. Now, from a diversification perspective, let's say you had your 30 stocks, but unless you had those stocks in the energy sector, there's no way you would have been well diversified enough if you really want to make sure you get your fair share of those returns. Now, you might think, okay, well, that's what the academics say, but how do the best investors actually do this in real life? And how does that compare to what your portfolio might look like? As usual, it wouldn't be an investing video on YouTube without dropping at least a little bit of wisdom from the big man himself, Mr. Warren Buffett. In this clip I'll play for you, here's Buffett's take on the whole topic of diversification and what he thinks it really means to investors. I'll break it down into 2 parts. Here's his personal take.
But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money, and I will guarantee you that going into a 7th one, is going to, rather than putting more money in your first one, it's got to be a terrible mistake.
Right then, so just 6 companies for Buffett, but then he did lay out a huge caveat at the beginning saying that this is really only for those people who dedicate their professional lives to it and can dedicate all the time it takes to do it. Now, I'm not sure about you, but how many of us have enough time to truly dedicate to picking stocks and making sure we find the best ones to invest in? So now let me show you the second part of the video, which actually comes just before the first part of the answer that you just watched.
If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs, because all they're going to do is own a part of America.
So much for Warren Buffett thinking diversification was a terrible thing and people misquoting him all the time, eh? Now, where does that leave you and I as regular investors? Well, I think there's a couple of different ways that we can look at this. Firstly, if you're going to pick your own investments and individual stocks, presumably you're doing it, like Buffett said, to make a lot more than the market. Obviously, you aren't happy with the boring returns of the stock market. You want your 20, 30, or even 40% per year, right? Now, let's give you the benefit of the doubt and say that you've picked some good stocks. You know what you're doing, or at least you think you do. Now, generally, what are your chances of beating the market? Well, here's a little nugget I always like to pull out when we look back into the past, and it's just how few stocks have actually given us all of those gains we see today in the stock market. Out of the thousands of stocks out there, only a very small amount actually do very well in the long term, and even fewer beat the returns of the wider market that we could have got just sticking to good old index funds. So if you see on screen now, here's some findings from a study by Crittenden and Wilcox, who looked at the thousands of companies inside the Russell 3000 index. If you've not seen this data before, let me tell you that the results are pretty eye-opening. So the takeaway points here are that only about 1/3 of all companies outperform the market, leaving the vast majority behind, meaning that you definitely need to think long and hard about your own choices. Secondly, only about 4% of all stocks are the ones that give you those really big returns of more than 30% above the index. And finally, on the negative side, a big fat warning that if you do find yourself on the downside, there were almost 18% of stocks which could have lost you more than 30% below the index returns. So ultimately then, this is a tough game and it's really hard to win, but you could definitely make a portfolio that was well diversified. It would just take a lot of time, a lot of effort, and then you'd have to really figure out every possible combination. So you'd want stocks in different industries, different countries, different currencies, and even areas of the market like bonds and commodities. The problem is then you end up with dozens of stocks that you've got to keep track of. And going back to Buffett's point earlier, do we really have the time to dedicate to this? After all, it's not just about time. We also need to be smart, patient, and have a strong stomach. Personally, I think a better question is, are you diversified enough for your own needs? This makes a lot more sense because after all, investing is about finding something that works for you in the long run, assuming that you even have that kind of time horizon. My fear and concern for a lot of investors is that they aren't diversified anywhere near as much as they should be because they've had a really easy time in the stock market over the past decade or so. And many stocks have caught the headlines with thousands of % returns, making many people millionaires in a short space of time. Or at least that's what it can feel like, especially when you have the same individuals sharing their wins on social media, totally forgetting the fact that what they did was extremely risky by almost all measures by going all in. Now, the tough thing though, I think, about trying to find out how diversified you should be is that until you experience that real pain in the stock market and you lose money from seeing your investments tank or even go to zero, you'll have no idea how you'll feel or react. From my own experiences, I've not seen an investment go to zero just yet, but I did have an investment in Evraz, the Russian mining company that used to be on the London Stock Exchange. I'd owned it for a couple of years, it produced great cash flows, great dividends, and was by all means a solid stock to own. But then, of course, the invasion of Russia into Ukraine happened, and we had all of the sanctions that ended up with the company being delisted, which now means that I've got a paper certificate of shares, which I guess are pretty much worthless for now. For me personally, it's not too much of a concern. I'd had some dividends returned to me and I'd only invested in an amount of money that didn't have any impact on my wider portfolio. But what if I had an amount in there which was almost too much to lose? What if I was all in like some other investors that seem to be with these fast growing hype companies? Well, the bottom line is you won't know how you feel until it happens. So I'd probably say stay on the more careful and conservative side until you do. Now, one final thing worth addressing is, can you be over-diversified? As I've seen this question asked a few times now as people worry about their investments overlapping. The common question says something like this: I already have Vanguard Life Strategy Fund, or I've got a global index fund. Now, what happens if I want to buy some more S&P 500 or some emerging markets or even the FTSE 100 funds and put them in the same account? So the answer to this question is that you're not necessarily over-diversified, but you are overcomplicating things and probably going to give yourself a bit of a headache. For index fund investing at least, the whole idea is to be passive and just let the market weights of the globe take care of themselves. All you do is buy regularly. Once you add in your own funds and keep adding more, all you do is slightly change those weights away from the index. Now, it's important to note that there's no way of knowing if you'll end up beating the market in the future. Like, for example, you could add in more UK funds and then it turns out the UK market has a tear for the next 10 years. Unlikely, but anything's possible. However, it could equally go the other way and you end up getting beaten by the market because you ended up making things too complicated. And we've not even mentioned fees yet or any cost for buying and selling, which can then make things even more complicated. Okay, I think there's two lessons here, or more like ways forward for you to try and work out if your own portfolio is diversified enough for you. One, if you are going to pick stocks and be a bit more active, try and work out and prepare for the worst case scenario. How would you feel if any of your positions or your largest position suddenly dropped in value by half or more because of some crazy black swan event? Would this impact your investing? Would this cause you to sell, for example? Would any single position have a real adverse effect on your life? For me and my own investments, I've decided that the vast majority should be dedicated to index funds. That's around 70% or so right now, and I've allowed myself 20% to invest in individual stocks, with about 10% going into some other private investments. Also worth saying that inside that 20%, no position will hold more than 25% or so, and I'll make sure that no single position will keep me up awake at night. Secondly, the other path forward, and many of you can guess already where this one's going, is that if you want to be diversified in the stock market at least and not have to worry about any of this mess, then just stick to index funds for your investing. Channel your inner boglehead and invest regularly into low-cost, globally diverse, passive index funds. Let the weights take care of themselves, especially if you've got no interest in this subject at all, and then pretty much don't look at your investments and go from there. I think many of us massively underestimate what it takes to be a shareholder and a stock picker. The real pain that you will likely have to go through if you want those outsized returns. And actually, the longer and longer I do this for, the less time I really want to dedicate to it, and the more time I want to spend finding more ways to get additional money to put in, rather than worry too much about where it goes. But then, that's just me. I'm not your financial advisor, so please find something that works for you and seek help if you need it. Now, if you're still looking to get a bit more detail on portfolio diversification, I did this really interesting video recently looking at whether the S&P 500 is enough to give you a well-diversified portfolio. The results might surprise you. See you in the next one. Happy investing.